Welcome back, everyone, to In Tune, a market note. It's been about 3 weeks since my last video, and I feel like enough has happened in the 3 weeks to provide you with some meaningful commentary rather than just commenting on the news. Um, and this way I can make things more thematic rather than just going through whatever happened, right? So here are a few themes that I want to talk about today. One is bulls versus bears. Basically, any given point in time, you're going to find both opinions. The next is AI. There's been a lot of news surrounding AI. I want to talk about the earnings, the state of AI, as well as its impact on um, our pockets, our labor market, all of those things. I do want to talk about the Fed. The Fed came out last week. The fact that they didn't do anything with interest rates was very much a secondary topic because at the forefront is the topic of Jay Powell and Kevin Warsh and confirmation hearings, etc. So I do want to talk about that. All right, let's start with bulls and bears. You know, there is a saying that um, stock market people, so people who do research on the stock market, tend to be more bulls, and that people who look at invest in the bond market or do research on the bond market are bears. So there are these stereotypes that exist in the investing world. It's somewhat true because think about it. You have to be an optimist to put money into something as volatile as stocks, right? You have to believe that it will go up. If you think it's going to go down, then what so there's a little bit of a confirmation bias, or, there's some biases built into that sentiment of being bullish. Same thing with bonds and same thing with bears. Two general reasons. Again, these are stereotypes. Not everyone is like this. Two general reasons. One is that the bond market or the treasury market is much more closely tied to economic data. So, we talk about inflation or growth. You have an immediate reaction in the treasury yields, right? So when inflation tends to comes in hotter than expected, yields will spike up. When it's lower than expected, yields will go down, right? So there is a more direct link between economic fundamental data and the treasury market and therefore the bond market. The link between economic data and the stock market, it's a little loose. Actually, it's very, very loose. Okay. So the people who do research in the bond market and people who like the bond market tend to be a little bit of bears because there's always some bad news in the economy. Like, even when the economy is roaring, there's something to be concerned about. That's just life. So, when you're a bond investor, you tend to focus on that, right? And the other thing is, you sort of have to, it's like the stock market people. You sort of have to believe that the markets are going to go down, be a little bit of a bear if you're a bond market investor, because historically they've moved in opposite directions, right? Bonds are usually hedged for equity volatility. So again, there are biases that are built into this. If you're a stock or a bond investor listening to this, please know that these are just stereotypes that I'm talking about. I'm not talking about you. Okay. Why am I talking about this? Because I feel like sometimes people listen to these things and then they either get scared or concerned or exuberant. Depending on who you listen to and depending on what headlines you read, you can you can end up with their biases in your portfolio. And that's not necessarily a good thing because again, there's some selective, information gathering on both sides. But let me just say, it's healthy to have both perspectives because this is what makes the stock market go or the bond market go. You need buyers and sellers in order to make the marketplace work. So this is actually very, very healthy. What is not healthy is paying attention to one person because you think they're smart and then trading your own portfolios based on it, right? Because that's not how the market moves. Even if like I believe that the markets are going to go up because the fundamentals look great, et cetera, or the economic growth is we're just roaring, the economy is resilient, et cetera. you can have great fundamentals and for the stock market to continue to go down, right? So what does that do to your portfolio, right? So I'm trying to say, be careful with bulls and bears. There, you hear their cases all the time. Now, let me take the economic data that we got last week as an example. So we learned that during the first quarter, the US economy grew at a 2% annualized rate. So this means that if the growth rate for the first quarter had been for the entire year, it would have been 2%. That is what it's saying. We didn't actually grow 2% in 3 months. What I hear is, oh, business spending, AI, it was mostly AI driven. It's true. Like those are the facts. Those are what numbers are telling us. So there's no opinion in that. But then different people interpret things differently. So the bulls will say, or the bears will say, oh, it's only AI. And therefore the rest of the economy is tanking, or consumer consumption actually came in softer than you would expect, and consumption is 70% of the U.S. economy, and therefore what does that say about the rest of the U.S. economy, etc. And so people get pessimistic, right, when you look at it from that perspective. Now take the same information and take the bull case, which is, wow, look at how important AI is to our economy. Look at all the promises of AI, agentic AI. I use agentic AI every single day. I mean, I check it, but it saves me a lot of time. It gets me in the ballpark. It processes information and data, mountain loads of data, a lot faster than I can manually, right? So incredible. So think about what that means for the future of the economy and imagine the investment that's going into it right now, right? Now, if you look at it from that way, you become bullish. And you can suddenly think, okay, maybe the stock market valuation on these companies is reflecting that future rather than just, people just piling into these names for no good reason, which is also how sometimes it's portrayed, right? There are many different ways to take the same information and come up with many different ways of looking at the same information, perspectives and sentiments, right? So that's one example of how recent data point that really has nothing to do with the Max 7 companies or the treasury market. And you can actually take both sides, either side actually, and then trade based off of it. Like if you were scared, you would be like, okay, sky's gonna fall. The stock market kept going up. It kept hitting record highs. I'm just going to sell. That can happen too. But these positions and sentiments are never really meant to be traded on. Okay. And the reason why I'm mentioning this also is because I get questions all the time. I get questions about bull case, bear case. When the markets were going down in March, people were like, are you selling? What should we be doing? I'm like, nothing. If anything, I'm putting new cash to work. Right. So anyway, bulls and bears, take it with a grain of salt. Okay, so let's talk about that AI. AI was a very big part of economic growth in the first quarter. And frankly, that wasn't the first quarter. It has been that way throughout 2025. AI is definitely showing up in the economic numbers. And then, of course, we had the Max 7, parts of the Max 7 companies report last week. And semiconductor companies have been reporting as well. The numbers are astounding. So I'm going to share some numbers with you here if I can pull them up. Microsoft, Azure was up nearly 40%, or it's expecting it to be about 40% year over year. Google also beat. Amazon beat. Everyone sort of beat. And Meta also beat, but I'm going to come back to Meta in a second. Apple also beat. And they mostly had an incredible stock price appreciation or reaction. Now, why did I single out Meta? I singled out Meta because, like everyone else, they're spending a lot on AI infrastructure. Now, if you're Google or Amazon or Microsoft, you're a hyperscaler. So it makes sense to be investing lots of money, if you truly believe in it, in AI infrastructure, on data centers and everything, and chips, everything that's going into it, because that is a very big part of your business, selling capacity. right? Hosting people on your, cloud, like that is your business. So you're going to be able to see or be able to identify return on that investment by talking about, hey, listen, all these subscribers, we saw growth, or earnings on the data centers went up by X amount. You can actually put your finger on how much your business is growing due to these investments. Meta is different because even though it's a part of Magnificent Seven cohort, Meta is not a hyperscaler. Their business is not in building these infrastructures and then sort of leasing them out, right? To make it really simple. So the question then is, what does the return on that investment look like? And frankly, right now, it's difficult to tell, right? We can't have a line item that we can point to and say, hey, that's growing, and therefore we're okay with it. So Meta, the 1 day stock performance after its reporting fell about 10%. It did not do well. It said that it was increasing AI spend on top of that. The question is, are the investors buying it? Are the investors saying we feel comfortable with this amount of spend and increasing spend on AI when we can't tell what's going on here? And then you hear about Meta actually firing people, and lots of layoffs, like 10% of its staff, et cetera, in order to invest more heavily in AI. So the question from an investor perspective can become, it's not always true, again, bulls and bears, right? It can become whether or not there's too much money going into one basket, right? Some people are questioning it. Some people are comfortable with it. And frankly, over the long run, I think they're going to be successful. It's just because they're not a hyperscaler, it's difficult to quantify, right? So anyway, this is the AI update from a corporate level. The big macro level message is that AI is real. The spend is there for a reason. We're learning that from the semiconductor companies, the demand for this stuff is out of this world high. Okay. The only thing that is constraining them is the supply, on the supply side. And that has to do with the fact that there's so much demand all of a sudden, and everybody wants them, and therefore it's creating a bottleneck from the demand side. The other thing is, things like Strait of Hormuz not being able to, countries, Qatar not being able to, export helium, all those things. Yeah, it can be a constraint, and down the road. So yeah, no, it is a real thing. And if you think about agentic AI, right? I use it every day. And just in the last, since January, December to April, just in about 4 or 5 months, it has progressed at an astronomical rate, and meaning it has developed and gotten better. So I don't think this is going to go away. I think the investment is purely that if you go from where we were to going to agentic AI, the amount of computing capacity that you need is just like, it's exponential, right? And therefore, from what we needed before, and therefore the building of the computing capacity is a sheer need. And I don't think we're necessarily overbuilding. It doesn't mean that we're not going to have data centers that are going to be not doing as well, right? Because that is not about demand. That is about a lot of other things, including the management of the asset, right? And being able to find the partners to lease it. There's a business case for why certain data centers may fail. Inability to connect to an energy source. There are all these other things. It's not because AI is bust. And that, I think, is another story that is misaligned out there. A lot of people, you'll see a headline about, oh, such and such data center has been built for the last 3 years and it hasn't been able to open because of it. It's not because there isn't enough demand. It's because of asset management issues, if you really read into it and find out the details. So AI demand is real. but not every data center is going to be successful, right? So who builds them, who maintains them, who manages the assets, all of these things will be important. Okay, that's on AI, the exciting part of AI. And I'm going to throw a little bit of cold water on this because there is an impact on AI that's not desirable, and it's because of the sheer speed at which AI is coming at us. We can't adjust to it this quickly and not have casualties. And what do I mean by that is the K-shaped economy that we already have. The bifurcation between the haves and have-nots might be growing more, and that is worrisome. Not necessarily from an investing perspective, but just from a humanitarian perspective, and it's stuff that we should care about. It's stuff that we should always also be paying attention to. I don't think AI is going to take over every job. AI is not going to be able to take over my job because, if you're a creative thinker, maybe AI could compete with me on being creative, but it can't replicate what I'm going to do because it can't read my mind. Not yet, at least. But there are jobs that the AI, enterprise can take over, which we already have seen, which is coding. I don't think there is a serious coder who has coded since maybe December of last year. And AI is faster and better at coding. And that has had a real impact on the workforce. People who have built their careers on coding and software, we're hearing about a lot of layoffs in that department. And that has a real impact on society, right? We don't know how AI is going to impact all of our industries. I have my own thesis, but we haven't yet seen it. So it's difficult to really understand the impact on the labor market, because labor market is what supports all these industries, right? And so this is something we need to pay attention to. We need to be mindful of. Right now, the labor market seems to be frozen. There's very little firing. There's very little hiring. Last year it was because of tariffs, and I feel like now it's because of AI. Companies don't want to fire people because, they need them, but they also want to consider AI before they go on hiring people. And they want to experiment. They don't know yet how AI is going to become a permanent part of their daily processes, but they want to experiment. They want to see. And that's causing a little bit of a freeze in the labor market, in my opinion. College graduates are having a hard time finding jobs because, especially those who are coming out now, or maybe even last year, their college experience was before AI became agentic, right? So, but guess what? Like, I have all the optimism about young people because you can learn really fast. And you're going to be able to get into a company and adapt AI much quicker than people who have been using old systems. And you will become indispensable in that organization. I just want to say that. And I want to say to employers, if you have the capacity to, I would encourage hiring as you would have before, because you're going to need people to use these AI systems in order for you to find productivity. You can't just try to find productivity in AI without the people who can learn fast and who can utilize it fast. So that's my little, 2 cents on the labor market and AI. And finally, I want to talk about the Fed. So if you've been paying attention to some, economic / political news, Kevin Warsh, who was President Trump's pick to be the next Federal Reserve chairperson, he was in front of Congress getting grilled. Okay, this is just par for the course. Everyone gets grilled. If you want any kind of appointment from the executive branch, you're going to have to appear before Congress, and you're going to have to spend your time answering some difficult questions and sometimes uncomfortable questions. And I watched a little bit of it. I couldn't watch all of it because it was so uncomfortable. And oftentimes it's just a game of just let me get through it, right? So it's a little bit of a tennis playing, or, ping pong playing, whatever you want to call it. And the art of not answering. or answering in a different way, right? Or answering in a way that you prepared. It's actually highly admirable in a way because I don't think I could do that. Anyway, it's almost a guaranteed thing that he was going to be, it was going to pass and he's going to get he's going to get confirmed like that. That's it. This is just the process. What was the news was the fact that Jay Powell, the current chairperson, came out last Wednesday and basically announced the policy, which was not cutting or raising rates. The policy, interest rate policy, stayed the same, which normally would be news, but nobody cared because the question really was, will Jerome Powell stay on the Federal Reserve as a member, right? Because he has the ability to. He won't be the chairperson anymore, but he can stay on as a member of the Federal Reserve. And he told us he would. Right? There are a lot of interpretations about this. Some people are saying, oh, he is so spiteful, he just want to stay on to, give it back to President Trump. You know what? I have a lot of faith in Jerome Powell and these officials. At the end of the day, they're not pawns. I don't believe that. You can call me naive, but I really honestly think these people are too smart. And they also care about their legacy more than you think. So if they actually, let's say they do bidding of some powerful person and the economy, the inflation goes rampant, or that's their legacy. And you have to think that people care about their own legacy and how they go down in history. I mean, that's a selfish way of looking at it, selfish angle, other than the fact that they become some public servants. Anyway, so I think that Jerome Powell is staying on because of, number one, there's a lot of hurt right now in the credibility of the Fed because of the chirpings of, I'm going to fire this person and that. And there's been a lot of lawsuits. This is not healthy because the independence of the Fed is sacred. And we rely, at least in the perception, right? I do think that the Fed is independent. In order for the markets to work in a healthy manner, okay? If at all the market starts to believe that it is rigged in some way, then the markets can't trust it and it can't trade on it. The price discovery disappears, right? So it's not healthy for the markets. And I do think that because of all of these scars that we have with regards to the credibility of the Fed, I think it is very helpful for Jerome Powell to stay on the Federal Reserve to help with the continuity and to help with at least the perception of independence. Because as long as he's there, I think, having been a former chairperson, I think it's very helpful to have that kind of trust. So there's no political angle there, in my opinion. I do think that he is making that decision for the health of the markets and for some healing. We need some healing here when it comes to the topic of the Fed. I am happy to see that the lawsuit has been dropped by the Justice Department. That is the right thing to do. And that is my opinion. Again, he's full of opinions. And yeah, it was just causing a lot of noise. It was causing a lot of hurt in terms of how we view a very, very large institution that controls the interest rates. It's whether or not you think the Fed is good or not, I mean, there are lots of opinions about this. It remains that they're a very important institution. Okay, that's it. See, I told you a lot happened and I had a lot to talk about. All right. Well, I don't know when the next time I'm going to be uploading a video. I don't think it'll be very long because the markets always give us a lot of things to talk about. So be healthy and be well until next time. Thank you.